Hey guys, welcome back to another video. Today we're going to be covering the book building process. Now, book building is among the three different mechanisms used to complete an initial public offering, an IPO. Now, the three mechanisms are auctions, where shares are sold to several competing bidders, which establishes a stable price. There's the fixed price offering, where shares are offered at a preset price, which is determined internally. And then there's book building, where information is collected on how much investors want and what they are willing to pay. By taking that information and kind of building a demand curve, the investment bankers, the underwriter, is able to look at, based on this X amount of shares that we're going to offer, and based on the amount of interest in this issue, we can price it at X dollars. And so by using that information, they can accurately project what is a good price and what will be met in the market with strong demand. So it is important to understand, with most banks guaranteeing the process of an issue, which is referred to as a bought deal, the investment bank exposes itself to a great deal of risk. By using its own capital to buy the whole issue at the established offer price, the bank now needs to distribute these shares. So in the modern IPO market, most IPOs are bought deals. So the big investment bank, the underwriter, will buy all the shares from the issuer, from the private company, and then it's their responsibility, and they're liable because they put up their own capital to buy those shares, to then distribute them to the investors, whether it's institutional or private. Now, if the bank underprices these shares, it can leave money on the table, whereas if it overprices these shares, it can stand to lose a lot of money because it's marked to market. So at the end of the day, they're going to price those shares and say, for example, the deal doesn't go well, so they overprice it. And so when they list the shares, the stock falls significantly, and especially because people will anticipate further falls as the bank needs to unload those shares. So there's a lot of selling pressure, and so the stock keeps falling. And in that case, the inventory held on the balance sheet, the value of that inventory will decline, and I'm pretty sure a bunch of people will get fired in that case, which is not good for the bank itself because they've put their capital at risk. So this means that pricing the issue at the correct cutoff price, the cutoff price is where the initial IPO price is set, is very important for both the issuer, who needs to raise money and build investor trust, and the underwriter, who puts up their own capital for a period of time and has a reputation to protect. Because in an IPO market, part of that reputation involves showing the client, hey, we've done X amount of IPOs, all of them have been successful, we've been very accurate on projecting the right price, the correct price, so we haven't overpriced or we haven't underpriced it. And so that reputation is very important. So the book building process allows the underwriters to test this market demand for the issue through the advanced gathering of indications of interest to avoid such problems. So it's become very, very common in the current market because it helps accurately project the demand in the market by going to investors and getting their interest and really determining how interested they are at what price. So there is a pre-marketing phase, a roadshow, during which underwriters gathered indications of interest from would-be investors. And this essentially states how many shares they would be interested in purchasing and at what price. By going and meeting with institutional investors and groups of retail investors, bankers are able to start with a valuation range determined internally using comps and DCF, and then work towards a set cutoff price, a specific cutoff price for the issue, which is then put into, of course, the prospectus, which will be distributed to all investors afterwards. So there are 4 key steps to the process. Step 1 is due diligence. You then collect those indications of interest. You collect those bids. You then price discover. So you have that price discovery phase, and then publicize and settle it and complete the IPO. So step 1, due diligence. Once an investment banker is assigned to the project, he or she would conduct a full analysis of the company, projecting the value of the business under different scenarios in order to come up with a valuation range. And that range, it's they say between 10 to 15% of what the eventual cutoff price will be. That should be the range. And so once they determine that and they set this range defines a price ceiling and a price floor, that cutoff price, that the price at which the IPO is priced, is what the book building process will eventually determine. So they take that range and they go on the roadshow and they source that interest. So in step 2, they collect the bids. So a group of investment bankers go on a makeshift roadshow to visit institutional and retail investors in order to gauge their interest, eventually convincing them to participate in the bidding process. Working off the internal valuation range, the bankers can start to determine at what specific price there is enough demand for the issue. These groups submit their bids based on this range and how much they would want. In step 3, once the investor interest has been gauged and the bids have been collected, the weighted average is usually calculated to determine the appropriate cutoff price for the issue. Usually the outliers, the aggressive bidders that really bid out there above what the most of the institutional pack had bid, they are removed from the average in order to fairly capture the demand curve for the issue. And then by looking at that demand curve, they can then determine, okay, based on X amount of shares that we're going to offer to the market, we can price it at this because this is a good clearing price. In step 4, once a cutoff has been determined, the IPO process can be concluded with the underwriter allocating a set amount of the issue to all the bidders at the finalized cutoff price. Now, the book runner, the main manager, has discretion over who receives allocations of IPO shares. Only the lead bank's manager has real knowledge of the book that compiles all indications of interest. So it gives priority to large customers and institutions seeking to establish repeat business. So they really dictate where a lot of the issue goes to. And they have a lot of vested interest in keeping these large customers and institutions that trade with the investment bank happy. So they usually allocate those shares to those individuals. And so that's essentially the process. Now, what's the difference between the book building process and the fixed price mechanism? I think is really important to understand. Even though it's very old, the fixed price mechanism is not that much used anymore. It's very uncommon that you'll see that. So the fixed price mechanism involves much more liability for the investment bank, as it is tasked with pricing the security through internal analysis and valuation. Instead of determining a valuation range internally, the investment banker needs to also decide on the cutoff price. So there's a lot more responsibility and there's a lot more pressure on that investment banker or group of investment bankers to really determine what the best price is. And with only limited information and not a lot of interaction with the people that are actually going to be buying this issue, it doesn't make sense. And majority of the time, there's a lot of risk and liability, and a lot of the times there's either underpricing or overpricing. So while the fixed price method is cheap and quicker because you don't have to go on a roadshow, it is much more inaccurate from a demand perspective, which increases the risk to the bank's capital. So in conclusion, the book building process has become the popular option for underwriters in the global capital market space because of its ability to accurately analyze demand from a price perspective, which ensures a fair cutoff price to successfully complete the issue. While some companies, and the big example was Google, the Dutch auction process, have chosen other auction pricing methods, book building is largely preferred over the fixed price mechanism. And if you are interested in learning about the auction pricing methods, I did make a video on the Dutch auction pricing mechanism, and that's gotten a lot of views, and I do talk about the Google example. But book building has become the number one alternative, the number one option for the IPO market, and it makes sense because it really does collect the most valuable of information and accurately projects what that cutoff, that good clearing price will be. Thank you so much for watching, and please like and subscribe to the channel for more videos. Take care, guys.